How do firms think about entering and exiting markets in the long run? How do they make choices when they no longer have any fixed factors of production? Economists think about these questions when dealing with firms operating in the long run. I'm Professor Andrew Simon, and this is Economics for Everyone. In previous videos, when we've discussed the seller's problem, we've treated the facilities and the machinery, the physical capital, as fixed. Firms were not able to change those inputs. Intuitively, over a short time frame, a firm cannot change inputs like their buildings. So over a short period of time, firms determine only how to optimally combine some of their factors of production, what we call variable factors of production, to maximize profits. But firms often think about more than just each day's production. Here we're going to think beyond the short-run supply decisions and move to the long run, where firms can choose how much of all of their inputs they want. In the short run, sellers deal with variable and fixed factors of production. A variable factor of production is an input that can be changed in the short run, and a fixed factor of production is an input that cannot be changed in the short run. However, the long run is a period of time when all of a firm's inputs can be varied. Since all factors can be changed in the long run, nothing is fixed. Even machines and buildings can be retrofitted or replaced. Because of this, there are important differences between the short and long-run supply curves. Let's think about our favorite bakery. The baker has many variable factors of production over which they actively make decisions each day, including how much flour and sugar to use and how many workers to employ. The baker also has fixed inputs that they cannot change today, like the size of their kitchen and the number of ovens that they have. If the baker wants to change production today, say double the number of cakes they make, they can only change the variable inputs. The baker can hire another worker and purchase more flour and sugar. However, in the long run, the baker's kitchen machinery is no longer fixed. They can now search for the optimal combination of all of their inputs. They can choose to get an additional oven and then choose how many more workers they want to hire with the new higher capacity. The firm will make these decisions to minimize its costs. Therefore, the long-run average total cost curve will be below the short-run average total cost curve. When the bakery is better able to adjust their choices to reduce costs for a given level of production, they can do better. The average total cost curve, that is, how the average total cost changes as production increases, informs us about the nature of scaling up production. How do costs change when we want to produce more goods? There are three cases to consider: economies of scale, constant returns to scale, and diseconomies of scale. Economies of scale occur when the average total cost falls as the quantity produced increases. This means that if the bakery increased the number of cakes produced, the average total cost falls. Constant returns to scale exist when the average total cost does not change as the quantity produced increases. If the bakery has constant returns to scale, then the cost of producing each additional cake is the same, and the long-run average total cost curve is flat. And diseconomies of scale occur when average total cost rises as the quantity produced increases. If the bakery has diseconomies of scale, then the long-run average total cost curve is upward sloping. In the long run, firms may also exit the market. Let's go back to the bakery. When the price of a cake is lower than the average total cost, then the bakery loses money on every cake that it sells. With total revenue less than total costs, the bakery has negative economic profit. The bakery must therefore exit the market. This gives us the exit rule in the long run. If the price is less than the average total cost, then the firm exits. The ability to exit is one of the key distinctions between the short run and the long run. Just as a firm may exit in the long run, other firms may enter. When would a firm decide to enter a market? If there is free entry, that is, if there are no legal or technical barriers to start a firm, then new firms will continue to enter a market as long as there are positive economic profits. Entry into a perfectly competitive market stops when there is zero economic profit. As more firms enter, economic profit of all firms decreases to zero. This zero economic profit is one of the key outcomes in the long run in a perfectly competitive market. Unlike in the short run, all factors of production are considered variable in the long run. This means that the shape of the supply curves can look very different. Knowing how firms operate in the long run is important because economics is for everyone.